let's also try and tell you what could happen in one key sector for earnings. Now, fuel retailing been in news the last month or so with volatile crude prices and the government decision to ask them to absorb some of the high prices weighing on the stocks. But none of this will reflect on the second quarter numbers, which begin today with BPCL. Samit's drawn up a list of what could be in store for the state-run OMCs. Samit, good morning.
Good morning, Neeraj. Now, if you see for all the three oil marketing companies, it is expected to be a muted quarter on the back of lower inventory gains and a weaker rupee. However, if you exclude the inventory gains, it is expected to be a steady performance both in the refining and on the marketing segment for all the three oil marketing companies. Now, inventory gains are expected to be lower in the second quarter because crude had averaged only 1% higher compared to first quarter, while in Q1 it had averaged nearly 12% higher compared to Q4, and that's the reason why inventory gains would be lower for all the three oil marketing companies in the second quarter of financial year 2019. Now, if you see the fuel margin, that was largely stable and should result into a steady marketing segment for all the three oil marketing companies. Now, in Q2, the gross marketing margin earned on sale of per litre of diesel averaged around 2.2 rupees per litre as against 1.9 rupees per litre in the last quarter, while for petrol it averaged around 1.6 as against 1.5 in the first quarter of financial year 2019. So a steady marketing segment is expected to report is expected from all the three oil marketing companies. Now, if you see for Indian Oil Corporation, the revenue is expected to be higher by like 6%, EBITDA is expected to be down by nearly 25%, but that would be because of inventory gains. Margins are expected to contract to 9%, while net profit is expected to be lower by nearly 25%. For BPCL, which will be reporting its numbers today, the revenue is expected to be higher by 9%. Again, EBITDA is expected to decline by 18% because of lower inventory gains. Margins are expected to contract to 4.1%, while net profit would see a decline of nearly 22%. While for HPCL, same thing, revenues are expected to be higher by 8%, EBITDA would decline by 13%, margins would contract to 3.8%, while net profit, now that would decline by nearly 13% to 1,500 crore rupees. Now, on the operational side, if you see, now the gross refining margin, that is the key number for all the three oil marketing companies, now that is expected to decline compared to last quarter, and that will be because of lower inventory gains. For Indian Oil Corporation, BPCL and HPCL, the GRMs are expected to come in at around $6 to $6.5 per barrel. Now, on the crude throughput side, for IOCL and BPCL, for IOCL and HPCL, the crude throughput is expected to be higher. For Indian Oil Corporation, it is expected to be nearly around 17.92 MMT. For HPCL, it is expected to be around 4.7. Now, for BPCL, it is expected to decline because of the fire incident in one of its Mumbai refinery, and that's the reason the crude throughput is expected to be lower for BPCL. Now, on the sales side, if you see, because of seasonal weakness, all the sales are expected to be lower for all the three oil marketing companies, and that's the reason the sales will be lower for all the three oil marketing companies. Now, key things to watch out for. Now, that would include the company's crude sourcing strategy because of Iran embargo and because of the decline in Venezuela crude production. So crude sourcing strategy would be one of the key things to watch out for from the oil marketing company earnings, and also how the company is planning to absorb this 1 rupee impact in the Q3 that will be seen because of lower because of the cut in petrol and diesel prices. So how will be they absorbing this impact will be one more keen thing to watch out for from the oil marketing company's earnings.
Okay, we'll watch out for these. Samit, thanks so much for joining in and giving us that perspective. So that's the OMCs, and well, Q2